Real estate investing without tenants, without repairs, without property managers, without a down payment, without needing to qualify for a mortgage. That's what REITs give you. Real estate investment trusts are publicly traded companies that own income-producing real estate and are legally required to distribute at least 90% of their taxable income to shareholders. You get real estate exposure, professional management, liquidity, and income, all through a stock brokerage account. In 2026, the interest rate environment has shifted meaningfully from the rate cycle of 2022 and 2023. REITs, which were hammered during the rate hiking period, have begun recovering, and the five we're covering today are positioned particularly well for the environment ahead. Before we get into the picks, a quick primer on what makes a REIT investment grade versus a yield trap. Quality REITs have four characteristics: a payout ratio that leaves room for coverage, funds from operations, or FFO, divided by dividends paid should be under 80% for sustainability, a strong balance sheet with manageable debt relative to assets, a sector with durable demand drivers, and management with a track record of growing the dividend, not just maintaining it. A high yield alone is meaningless. Many REITs cut their dividends during COVID. The ones that didn't, that maintained or grew payouts through the worst economic disruption in a century, are the ones worth owning long-term. REIT 1, Realty Income Corporation, ticker O. Realty Income is the anchor of any serious dividend real estate portfolio. Over 640 consecutive monthly dividends paid, more than 120 dividend raises since going public. $50 billion plus in net real estate assets across 15,000 properties in the United States and Europe. The portfolio is built on net leases, long-term contracts where tenants pay property taxes, insurance, and maintenance on top of rent. Tenants include 7-Eleven, Dollar General, Walgreens, and Walmart. These are not businesses that go away in recessions. They're defensive retail anchors with multi-decade lease histories. The current yield is approximately 5.5 to 6%. The FFO payout ratio sits around 75%, leaving meaningful coverage. Realty Income recently entered Europe through acquisitions in the UK and Spain, diversifying its revenue base internationally for the first time. For a core real estate position, something you hold for 10 to 20 years and let dividend reinvestment do the work, Realty Income is the baseline. It doesn't produce exciting short-term returns. It produces consistent, compounding income with low drama. It's worth understanding exactly why net leases are so different from the residential real estate most people are familiar with. In a standard gross lease, the kind that covers most apartment buildings, the landlord pays property taxes, building insurance, and all maintenance costs out of their rental income. When property taxes rise or the roof needs replacing, those costs come directly out of the landlord's margin. That variability makes residential rental income harder to predict and model. In a net lease, the structure flips completely. The tenant pays property taxes, building insurance, and maintenance directly on top of their base rent. Realty Income receives clean, predictable rent from every single property in its portfolio regardless of what happens to local property tax rates, insurance costs, or maintenance needs. The tenant absorbs all the cost variability. This is precisely why Realty Income maintained and even grew its dividend through the COVID pandemic, through the 2022 rate shock, and through every recession in its public history. The income structure is fundamentally more stable than most real estate investors realize when they first look at it. REIT 2, Prologis, ticker PLD. Prologis is the largest industrial REIT in the world, owning and developing logistics facilities, primarily large-scale warehouses and distribution centers, across 19 countries. Its tenants read like a roster of global commerce: Amazon, FedEx, DHL, UPS, Home Depot, and hundreds of major retailers. The thesis for Prologis in 2026 is structural. E-commerce still represents only 15 to 17% of total retail sales in the US. As that percentage continues growing, the demand for last-mile fulfillment infrastructure grows with it. You can't ship from a website, you ship from a warehouse. Prologis owns the warehouses. Think about the economics. When Amazon sells you something, that product needs to move from a fulfillment center to your door. The fulfillment center is likely owned by Prologis. The last-mile distribution hub that sorts that package for your neighborhood is likely owned by Prologis. The speed of delivery you've come to expect, same-day or next-day shipping, requires multiple redundant warehouse locations in every metropolitan area, owned and managed by professional logistics operators. Prologis is the largest of these operators globally. The yield on Prologis is lower, approximately 2.5 to 3.5%, because the market prices in significant future growth. This is a dividend grower more than a current income play. But Prologis has raised its dividend by 10 to 12% annually over the past 5 years, which means today's low yield on shares you hold for 5 more years may look very different. An investor who bought Prologis 5 years ago at a 3% yield now receives that dividend on shares that have appreciated significantly. The effective yield on cost is substantially higher. A note on the current supply and demand environment for industrial real estate. The national vacancy rate for industrial properties in 2024 sits at approximately 6.5%, which is meaningfully higher than the record lows below 3% posted in 2021 and 2022, but still tight by the standards of the last 2 decades, where industrial vacancy historically averaged 4 to 5%. The market has loosened somewhat as a wave of new construction delivered supply in response to the pandemic-era demand surge. But Prologis's average lease term runs approximately 6 to 7 years, which means a substantial portion of their rent rolls are locked in at rates that were set during the lowest vacancy environment in modern history. Even if market rents soften in the short term, Prologis continues collecting above-market in-place rents on multi-year leases. By the time many of those leases expire, the construction pipeline will have worked through the market. For investors who want real estate income that grows faster than inflation, Prologis is the pick. Pair it with Realty Income for balance between current income and income growth. REIT 3. Healthpeak Properties, ticker DOC. Healthpeak targets healthcare real estate, medical office buildings, life science research facilities, and continuing care retirement communities. The demographic driver is simple and unalterable. The U.S. population aged 65 and older will grow by 20 million people over the next decade. Medical office buildings are particularly compelling. They serve essential, non-discretionary healthcare needs. Doctors' offices, outpatient surgery centers, imaging facilities, these don't empty out in recessions. Patients don't postpone MRIs because stocks are down. Healthpeak recently merged with Physicians Realty Trust, expanding its medical office footprint significantly and improving economies of scale. The demographic math behind Healthpeak isn't a projection. It's already locked in by the birth records. There are 78 million baby boomers in the United States. The oldest turned 78 in 2024. At age 77, approximately 15% of Americans require some form of assisted living, skilled nursing care, or significant medical support. By age 85, that figure reaches 40%. As the boomer generation moves through their 80s over the next decade, the largest cohort of elderly Americans in the country's history, the demand for healthcare real estate isn't theoretical. It is actuarial certainty. Every single person born in the baby boom years is already alive and aging. The healthcare system needs to be physically ready for them. Current yield, approximately 5.5 to 6.5%. The portfolio's focus on outpatient care, driven by the shift from expensive hospital settings to more cost-effective outpatient facilities, positions it in one of healthcare real estate's fastest-growing segments. REIT 4, Agree Realty, ticker ADC. Agree Realty takes the net lease concept from Realty Income and applies it to a tighter, more selective portfolio of necessity-based retailers. Walmart, Home Depot, Tractor Supply, Dollar General, TJX Companies, and Kroger. These are the stores people shop at in good times and bad times. What distinguishes Agree from Realty Income is the portfolio quality score. Agree has one of the highest investment-grade tenant percentages in the net lease REIT space. Over 60% of its annualized base rent comes from tenants rated investment grade by major credit agencies. Investment-grade tenants default very rarely. The dividend is paid monthly. The yield is approximately 4.5 to 5%. The dividend growth rate over the past 5 years has been approximately 6% annually, meaningfully above inflation. On shares held for 10 years with reinvested dividends, the effective yield on cost becomes substantially higher. REIT 5, Alexandria Real Estate Equities, ticker AG. Alexandria is a specialized REIT in a category almost nobody talks about: life science and technology campuses. It owns, operates, and develops research campuses housing pharmaceutical companies, biotech firms, and technology companies, clustered in innovation hubs like the Boston Seaport, San Francisco's Mission Bay, San Diego's Torrey Pines, and Seattle's South Lake Union. The tenants are not mom-and-pop shops. They're Bristol-Myers Squibb, Pfizer, Illumina, and hundreds of emerging biotech companies funded by venture capital to develop the next generation of drugs and medical treatments. Life science real estate has among the highest barriers to entry of any property type. Building specialized research facilities with the right structural, mechanical, and safety requirements is expensive and time-consuming. Alexandria has raised its dividend for 13 consecutive years. The yield is approximately 4 to 5%. The growth story is driven by the relentless expansion of pharmaceutical research spending, which in the U.S. alone exceeds $100 billion annually and grows with every new disease requiring new solutions. What makes Alexandria compelling is the scarcity value of specialized life science real estate. You can't convert a standard office building into a research lab. Specialized HVAC, biosafety infrastructure, clean rooms, highly controlled temperature and humidity environments, and structural requirements for sensitive equipment make these facilities expensive and slow to build. That creates natural pricing power for the REIT owning them. When demand grows faster than new supply can be built, rents rise and tenants stay put. This is not a conservative hold for dividend income alone. This is a real estate company positioned at the intersection of two of the most durable growth trends of the next 20 years: aging demographics creating pharmaceutical demand, and technology applications requiring specialized infrastructure. The 60-year-old who needs a new cancer treatment didn't pause for bad markets, and the pharma company developing that treatment continues spending on research regardless of stock market conditions. How to build a portfolio with these five. A simple 5 equal weight allocation, 20% to each, would produce a blended yield of approximately 4.5 to 5%. On $50,000 invested, that's $2,250 to $2,500 in annual income. On $200,000, approximately $9,000 to $10,000 per year, $750 to $833 per month. For most investors, REITs should represent 10 to 20% of a total equity portfolio. Meaningful exposure to real estate economics without overconcentration in interest rate-sensitive assets. Hold REITs inside a Roth IRA or traditional IRA to avoid the ordinary income tax treatment on REIT dividends in taxable accounts. The tax drag on REIT income in a taxable account can meaningfully reduce net returns over time. For longer-term context on what REIT investing actually delivers, the MSCI US REIT Index, the broadest measure of US REIT performance, has generated a compound annual return of approximately 9.6% over the last 25 years. That number compares favorably to most bond categories and sits roughly in line with broad equity market returns, while generating significantly higher current income than the S&P 500 average yield. You're getting real estate economics, institutional management, and liquidity. The combination that makes no sense to pass on when the barrier to entry is a brokerage account and $100. And REITs carry a structural inflation protection that pure equity doesn't. Most REIT leases include annual rent escalations tied to CPI or set at a fixed 2 to 3% per year. As inflation moves, the income stream moves with it. A 5% yield in year 1 becomes a 5% yield on a meaningfully higher base in year 10, because the rents have been escalating the entire time. That's an income stream that protects purchasing power in a way that a fixed bond coupon simply cannot. The beauty of REIT investing in 2026 versus direct real estate: you need no capital for repairs, no property management, no lease negotiations, no tenant calls at 2 a.m. You own institutional quality real estate with world-class management teams, for the price of a stock commission. There is one common misconception about REITs worth clearing up before you buy. Many new investors look at a 5 to 6% REIT yield and compare it to a 4 to 5% savings account yield and wonder if the risk is worth the extra percentage point. The comparison misses entirely what's happening. A savings account pays 4% in year 1 and 4% in year 10 on the same dollar amount. A REIT like Realty Income pays 5.5% in year 1 on the shares you buy, and if the dividend grows 4 to 5% annually, which Realty Income has done consistently, the payment itself grows every year. The shares you buy today at a 5.5% yield effectively yield 8 to 9% 10 years from now based on your original purchase price. A savings account will never yield 9% on your original deposit. The yield-on-cost argument is the reason long-term dividend investors are so indifferent to short-term price swings. The price can move around, the growing income stream keeps compounding regardless. Which of these 5 is most interesting to you? Comment below and subscribe. Next week we're covering 15 signs you're already better with money than 90% of people. And most people watching this video won't realize how many of them they're already doing right.